There are 3 dates I want to put in front of you today. Not because they are alarming, but because they are real, they are specific, and once they pass, the financial advantages they represent cannot be recovered. The first date is December 31st, 2028. That is when a temporary senior tax deduction worth up to $6,000 per person, $12,000 for a married couple, expires unless Congress renews it. The second date is also December 31st, 2028. That is when the most favorable Roth conversion conditions most retirees will see in their lifetimes, close with it. And the third date is November 2028, the next presidential election, which financial experts broadly agree is the final realistic deadline for Congress to act on the Social Security Trust Fund shortfall before automatic benefit cuts begin to take effect. 3 windows, 3 deadlines, all converging on the same 2 years. You have time to act on all 3. But that time is not unlimited, and today I want to walk you through exactly what each one means and what to do before it closes. I'm Anderson. I spent 5 years as a financial advisor in New York, working with families through retirement planning, Social Security strategy, and the tax side of retirement income. This channel exists to make sure you have the information before the window closes, not after. Subscribe and hit the bell, because the rules around retirement taxes and Social Security change constantly, and I will always explain what those changes mean for your specific situation. Now let me walk you through all 3 of these windows, starting with the one that most directly affects how much tax you pay on your retirement income starting this year. The first thing to understand is what the new tax law actually changed and what it made permanent. Before this law was passed, the lower tax brackets that had been in effect since 2017 were scheduled to expire. If they had expired, the 12% bracket would have jumped to 15%, the 22% bracket to 25%, the 24% bracket to 28%, and the standard deduction would have decreased significantly. According to the Tax Foundation, the combined effect would have raised taxes for roughly 62% of Americans. That expiration did not happen. The new law made those lower brackets permanent. It also made the higher standard deduction permanent and indexed it to inflation going forward. For a married couple filing jointly in 2026, that standard deduction is approximately $32,200. For a single filer, approximately $16,100. These are not going away. They are now the permanent baseline. This is genuinely good news for retirees, and it is news that has not gotten enough attention because it was overshadowed by the more dramatic provisions in the same legislation. Understanding that the lower brackets are your permanent foundation is important, because everything I am about to tell you about the temporary provisions builds on top of that foundation. Now let me tell you about the provision that is temporary, and that creates the most significant planning opportunity for retirees specifically. Starting in 2025 and running through December 31st, 2028, a new senior bonus deduction is available to anyone age 65 or older. It is $6,000 per qualifying individual. For a married couple where both spouses are 65 or older, that is $12,000 in additional deductions. And here is the detail that makes this particularly powerful. This deduction stacks on top of everything else. If you take the standard deduction, the $6,000 goes on top of it. If you itemize, because you have a large mortgage or significant medical expenses, the $6,000 goes on top of your itemized total as well. Let me put real numbers on what that means for a married couple in 2026. The standard deduction, $32,200. The existing age 65 plus addition, $3,300. The new senior bonus deduction, $12,000. Total combined deduction, $47,500 of income completely shielded from federal tax before a single additional credit or deduction is applied. On a household income of $70,000, that leaves approximately $22,500 of taxable income, with most of that falling in the 10 and 12% brackets. That is a dramatically different tax picture than most retirees are expecting. There is a phase-out that begins at $75,000 of modified adjusted gross income for single filers and $150,000 for married couples filing jointly. If your income is near those thresholds, the deduction begins to shrink and phases out completely at $175,000 for single filers and $250,000 for married couples. Managing your income to stay below the phase-out line becomes an important annual exercise. But for the majority of retirees watching this video, for anyone whose household income falls below $150,000, this deduction is available in full right now for the next 3 tax years. And after December 31st, 2028, unless Congress extends it, it is gone. The second window sits inside the first one, and it is the reason that the next 3 years may represent the best Roth conversion opportunity most retirees will ever see. A Roth conversion means taking money from a traditional IRA, money you have not yet paid tax on, and moving it into a Roth IRA, paying the income tax on the conversion amount today. The money then grows tax-free inside the Roth for the rest of your life, and Roth accounts are never subject to required minimum distributions. The reason this window is unique is the combination of 3 factors that rarely align simultaneously. First, the lower permanent brackets mean the tax rate on your conversion income is as low as it is likely to be. Second, the $6,000 per person senior bonus deduction means you can convert more income before crossing into a higher bracket than you could in any other 3-year period. Third, if you have not yet begun required minimum distributions, which start at age 73 under current law, your income may be lower right now than it will be once RMDs force withdrawals from your traditional IRA. That lower income is the ideal conversion window. Every year you wait, your traditional IRA continues to grow, your future required minimum distributions become larger, and the tax you will eventually owe on those distributions increases with them. Converting now, at today's lower rates, with the senior bonus deduction available to absorb part of the conversion income, is a strategy that compounds in your favor for the rest of your life. 2 important boundaries to watch. If your conversion income pushes above the $150,000 threshold for married couples, the senior bonus deduction begins to phase out, which increases your effective tax cost on the conversion. And if your modified adjusted gross income crosses the IRMAA threshold, $212,000 for married couples in 2026, your Medicare Part B premium increases 2 years later. Every Roth conversion should be planned with both of these ceilings in mind. The third window is the one that gets the least attention in tax planning discussions, but that I believe is actually the most consequential for long-term retirement security. The Social Security trust funds are projected to face a funding shortfall in the early 2030s. If Congress does not act before that shortfall arrives, current law triggers an automatic across-the-board benefit cut of approximately 20%. The question of whether Congress will act wise, raising payroll taxes, adjusting the retirement age, modifying benefits, or some combination, is a political question that I am not going to pretend to answer. What I can tell you with confidence, based on the historical pattern of how Social Security reform has always worked, is this. The 2028 presidential election is widely regarded as the final realistic window for major Social Security legislation to be passed and implemented before the trust fund timeline arrives. Whatever administration takes office in January 2029 will inherit a system that is either stabilized or in crisis. The decisions they make, or do not make, will determine benefit levels, retirement ages, and taxation rules for the generation of Americans who are retiring right now. What does that mean for your claiming strategy today? If you are approaching your Social Security claiming decision and you have not yet filed, the next 3 years may be the last window in which the current rules, your current full retirement age, your current delayed retirement credit formula, your current spousal benefit structure, remain fully in effect. Filing decisions made before 2028 under the current rules are protected. Decisions made after potential legislative changes may not be, so let me bring all 3 windows together into the 3 things I would tell a client sitting across from me right now. The first is to use the senior bonus deduction every year from now through 2028. That means understanding what your income looks like each year, managing it deliberately to stay below the phase-out threshold if you are near it, and making sure your tax preparer is applying this deduction. Because based on what I have heard from people who have already filed their 2025 returns, some tax preparers missed it entirely. If you filed your 2025 return and this deduction is not on it, you can file an amended return using Form 1040-X. The window to recover that money is still open. The second is to take a serious look at Roth conversions in the next 3 years, specifically sized to fill your lower tax brackets without crossing your IRMAA threshold or your deduction phase-out ceiling. This is not a one-time decision. It is an annual exercise that requires looking at your full income picture each year and converting the right amount. If you do not have a tax professional who understands this interaction, finding one before the end of 2026 is one of the most financially valuable things you can do for your retirement. The third is to review your Social Security claiming strategy before 2028. If you are approaching the age at which you plan to file, do not wait until the political environment around Social Security becomes clearer, because by the time it does, your window to act under current rules may have closed. This is not a reason to claim earlier than your personal financial situation supports. It is a reason to make the decision with full information on your own timeline, rather than in reaction to policy changes after they have already happened. The window is open. 3 years is real time. 3 years of tax savings at the senior bonus deduction level, 3 years of Roth conversions at historically low rates, and 3 years to lock in a Social Security strategy under rules that still operate exactly as they always have. None of this requires panic. None of it requires rushing into a decision that does not fit your situation. What it requires is awareness and a plan. In the next video, I'm going to walk through the Medicare decisions that need to be made before you turn 65, because those decisions interact directly with the Roth conversion strategy we discussed today. If today's video was useful, share it with someone you know who is retired or approaching retirement. This is the kind of information that makes a real difference when people get it before the deadline, not after. Subscribe if you haven't, hit the bell, and I will see you in the next one.